of the hottest topics, undoubtedly, for us CPAs in the industry is Internal Revenue Code Section 280E. It has a really robust history from the point of enaction to the subsequent case law precedent that's been set, such that even though it is only a mere sentence in length, it has kept us searching for creative solutions to mitigate our clients' tax burdens. So here to discuss this topic in detail, excuse me, is profound subject matter expert Nick Richards. Nick is a former IRS trial attorney who began representing cannabis companies and had his first Section 280E audit in 2013. Since then, he has represented hundreds of cannabis companies in a variety of matters, including federal, state, and local tax matters, Bank Secrecy Act compliance and audits, M&A, tax and entity planning, and business development. Nick is a tax partner and chair of the cannabis practice at Greenspoon Marder, a leading AMLAW 200 full-service law firm with one of the first dedicated cannabis practices in the world. Nick has also sat on the board of several cannabis companies, and he is a national authority and speaker on the cannabis industry and an adjunct tax professor at the University of Denver. I am thrilled to have you here, Nick, and if it's okay with you, since this is not a panel format discussion, to the extent that we get questions coming in, I will just interject as you're going through rather than wait until the end, but otherwise the floor is yours.
That sounds great. Thank you so much, Melissa. And I'd also like to thank the New Jersey Society of CPAs and the New York Society of CPAs. Melissa, it's been a little while coming here on this presentation, so I'm really happy to be here today, and I really want to thank you personally for sticking in there for 3 years on this conference. I think way to go. It's the kind of tenacity and professionalism that the industry really needs, and is what is really bringing it along today and causing legalization and change in various states all across the United States. So it's really excited to be a part of that. I call it a movement. You know, it's interesting, that story, you know, starting 3 years ago and here we are. You know, as you said, 2013 was my first 280E audit. I started teaching 280E shortly after that. It was a fun time because in 2014 and 2015, there weren't a lot of people that knew about 280E. And, you know, if you were a CPA looking through your catalog of classes to take, and, you know, you went through transfer pricing and like-kind exchanges, and you got to marijuana tax, you took that class, right? So I got to talk to a lot of really qualified and wonderful CPAs across the country. And then as the years have progressed, I've seen those same CPAs grow their cannabis practices, and then, you know, legalization occurs in their states, and those practices grow, and away we go. So it's been really nice and a wonderful experience for me to be a part of that. And so I really want to thank the tax preparer, CPA, enrolled agent community. Really great to be part of such a wonderful community. I know there's some people online right now that I do a lot of work with, a lot of thought leaders, and a lot of the stuff that I'm going to present today, it's not my original ideas or anything like that. It's the ideas that have been going through the community and in the background of a lot of these cases for all along. And so I'm really proud to talk about them today and to get into some of this material. You know, like the industry, my practice has grown. I was an IRS trial attorney that left the government, oh gosh, about 10 years ago, I guess, and, you know, hung up my shingle and started representing regular taxpayers, businesses and individuals alike in tax court and audits and debt matters. It was new for me. When you're a tax attorney for the IRS, you don't handle a lot of debt matters, and so there was a learning curve there for me. And shortly after that happened, along came my first cannabis audit. And, you know, my practice had to grow as the industry grew. because there's just so much that the industry needs, and so much professional advice that is so important that the industry receives. And so I've joined Greenspoon Marder from my regional tax firm, which is a full-service, large, 26 offices law firm, because our clients need the services of a full-service firm and the sophistication of some of the kind of legal services that I heard Stacy and Ashley talking about earlier, that there are pockets of knowledge that are in some parts of the country and not some parts of the country. So I want to give a shout out to the folks in our New York office and just give them a little plug. Great folks as far as tax and M&A goes, top of their field, and I couldn't be the attorney I am without them. So I want to thank them straight up. We have the slides are available, and I encourage you all to download them. And I've tried to put a lot of information in there. Melissa, there's a lot of meat to those slides, I think, and it's good information. So I encourage you all to go ahead and make it yours. I would love to talk to people about the information in there. There's some stuff in there that is. In the end, we'll get to some stuff that maybe runs a little contrary to some provisions of the tax code. I think in our community, we need to be talking about these things, because the truth is that the tax code and Section 280E and the U.S. Constitution, they just don't fit very well together. And we can't quite get to that in the courts yet, but still it's true. And anybody who works in this area sees that, including the IRS. And, because of that, the cases and the decisions that we see in the public forum coming from the tax court and other courts, those decisions are a lot different than what is happening behind the scenes. And so, Melissa said that I have had hundreds of 280E cannabis clients and whatever, and that's absolutely true. But you don't see me trying a whole lot of cases out there, because the law is not in their favor in a lot of cases to go to court. And in most of my cases, what I'm finding is that the IRS recognizes that the law has gone a little beyond what is really where we're going to land. And you can really get a pretty darn good administrative settlement from them. Look, it's still painful. 280E is painful. But you'll get a worse result in the courts oftentimes. And so that's kind of a little bit of the reality that we're at now. And so you'll hear me talking about how some of these decisions don't really represent what's going on behind the scenes and the kind of audit results that we're seeing with the IRS. So we're going to talk about 280E today, and we've got quite a bit of time to do it. And I encourage you all to ask questions. There's some topics that we're not going to cover that I think are just important for me just to mention really quickly. First off, Bank Secrecy Act. Man, it's a big deal, right? And it's a big part of the Treasury Department's compliance program. If you're in the cannabis industry, you need to understand Form 8300, and you need to take it very, very seriously, and you need to get professional advice about it, and you need to follow it and check up on it and have that on your radar. It's very important. Next up, state and local taxes. Look, one of the things that the states believe is necessary for the industry is audits. That is how they want to ensure that their state industry is in compliance with the requirements that allow the federal government to step aside and let the states handle it. So here in Colorado, the first state to legalize cannabis for adult use, when that happened, the Department of Revenue came right out and said, look, every cannabis company is going to get audited every 3 years, period, end of story. That has been the case. They have been true to their word. And other states are also focusing on the cannabis industry as a source of audits because, number one, there's new taxes that they need to audit in order to understand and properly enforce. Number two, in enforcing those new taxes, there are other taxes that come onto the radar. And so specifically, sales and use taxes are a huge, huge issue in the cannabis industry. Look, the cannabis industry, it came from somewhere, right? And it's not an industry that has been historically, above board in getting information and having the kind of professional advice that enables it to comply with a lot of these very technical requirements. Sales and use tax, and specifically use tax, the states hate it, right? They think that sales taxes aren't being paid by a majority of their residences because they're all buying stuff online and they're not paying sales tax. And guess who's going to pay the price? The cannabis industry. They're going to get audited and they're going to get sales and use tax audits. And let me tell you, if you go out and you build $1 million grow and you don't keep your receipts and you don't pay sales tax on those supplies that go in and materials that go into building that grow, in 2 or 3 years, you're going to get an audit. And the auditor is going to say, prove you paid sales tax on that grow. And if you can't prove it, you're going to have $1 million of use tax that's going to apply, use tax on $1 million that's going to apply. And it's going to come out of nowhere, and it's going to be a big amount that's going to be hard to recover. So a lot of need to focus on other taxes besides just Section 280E. Mergers and acquisitions. Look, one of the things that I heard Ashley and Elster talking about is, getting the right professionals. Mergers and acquisitions is a very technical area. The 280E piece rides in it in a very intricate way that is really important to understand. And it could well be that your M&A professional is not your 280E professional. And so heads up on that. There's very specific knowledge that's involved there. And another shout out to my New York partners. Thank you so much for being my expert in that area. Those of you that want to look a little bit deeper into that, we do have this cross-border mergers and acquisitions webinar on our website that has some good information on cannabis cross-border transactions and some very, very expert panelists on that, some of which I'm sure are CPAs listening in today. What else? Entity planning, I'm going to touch on that a little bit, but there's a lot there as well. Business development. That's one of the great things I think that opens up in this industry. It started out, an interesting story. MJ Biz, the biggest event of the whole industry, I think it was 40,000 people went to it 2 years ago when it last was held. Started out in Colorado with, I think, 70 people. In 6 years, it grew to 40,000 people. That growth is also what has happened in our professional circle. And so we do a lot of introductions, and that's something I help a lot of clients with, introducing them to other cannabis operators and providers. And finally, tax controversy generally. Look, that's the core of my practice. I'm a former IRS trial attorney with the tax controversy practice. As Ashley said, and Stacy and Melanie echoed, it's real professionals that are leading into this industry. And watch out for these workarounds, these ideas that you can get around 280E. What I like to tell people is, look, you can't eliminate 280E. You can't even really reduce it. It is what it is. If you spend a cost and that cost is subject to 280E, I don't care what you do with it, it's still subject to 280E. So watch out with people that say that they can eliminate 280E and do things like that. It's just not out there right now unless you're fighting the constitutional challenge, which we'll get to. And again, the case law in this area is funky, right? We don't have a real solid case yet on exactly what are the costs of goods sold for a cannabis company. So it's still developing, and it is in somewhat a little plagued by some cases that were teed up, I would say, under some sort of false ideas about what's possible under the tax code. So watch out for ideas that summonses can't be enforced in cannabis audits. That's just not true. And because of that, we recently saw a case that was denied cert by the Supreme Court. And in the same instance, Justice Thomas came out and said, look, we need to re-examine Section 280E. So they had a case that was trying to ask them to do that. They denied cert and then said they need to do that. Why is that? That case was not the right case to be looking at 280E. And we have been plagued by cases like that have horrible facts, and the law ends up very bad for the industry. But we really don't have a win in the tax court at all for the industry at all. And that's where we are, unfortunately. So that's what we're not talking about, Melissa. So we're going to cover Section 280E. We're going to get into some Treasury regulations, some entity selection items. We're going to jump into some really decent recent case law. We're going to get into some of the weeds on Patients Mutual and the 16th Amendment argument. And then we're going to talk about Section 471C, a brand new inventory method code section that is a pretty hot topic right now in the cannabis industry. And finally, I'm going to kind of conclude with my crazy theory, which isn't just mine. It's being echoed out there by many, and it's not my original thought either. I think it is the result of just banging your head against this thing that's 280E and wondering how can this work in our system? And I would challenge everyone on this to think about whether things are meshing together well with the concept of what income is as we go through these slides. Great, and maybe that last theory, maybe it ties it all together a little bit. It's challenging, but maybe, we'll see. Okay, let's jump into it. Section 280E, so there it is, that's exactly what is coming from the Internal Revenue Code. It's a very short code section. As you said, Melissa, it's like the tail wagging the dog for the last 10 years or so. It's a very important tale, though, and it has serious economic impacts. Section 280E, I'm sure everybody knows, but it essentially disallows a deduction for amounts paid or incurred during the taxable year that consist of trafficking in a controlled substance. It only applies to a trade or business, and those of you who deal with hobby losses in those kind of cases can think about what that means. And it applies to a Schedule I or Schedule II controlled substance under the Controlled Substances Act. That identifying of what it applies to, whether it's a Schedule I or Schedule II controlled substance, that is the only part of the Controlled Substances Act that matters for purposes of tax and 280E. That's it. Is it a Schedule I or Schedule II controlled substance? If it is, that's the end of the inquiry into the Controlled Substances Act. Okay, so it does not disallow cost of goods sold. That comes straight from the congressional record. When Congress passed Section 280E during the height of the war on drugs, they said, look, it would not apply to cost of goods sold. That was echoed in the Champ, one of the very first 280E cases out of there, a California case. And in that case, they echoed that it did not apply to cost of goods sold. We'll talk a little bit about Champ. It's still relevant today. Later, we got, in Champ also, and later it's been echoed, we got the definition of trafficking. Again, there are trafficking definitions under the Controlled Substances Act. They don't apply to Section 280E. The definition that we get from Section 280 for 280E is, I paraphrased it a little bit there, probably should have put those quotes in there, more dots probably too, and some of those funny little boxes, but it's basically economic activity, buying and selling. Of course, buying, right, for a cannabis business is cost of goods sold, right? Let's think about that. So as we're looking at a business, it really applies to the selling so far. That's what we've really seen the courts distinguish. They may go further. We don't have that case yet, but right now it applies to the selling activities. Okay. Okay, so cost of goods sold. When we're trying to determine what is and is not cost of goods sold, we look to Section 471. And Section 471A basically says that the commissioner has the authority to set forth regulations to prescribe inventory methods for inventory, and this is very important, so to clearly reflect income. That is a theme that was going to come up again and again in this presentation today, this idea of clearly reflecting income. It is the purpose of our income code. It is the purpose and the underpinnings of many of the IRS's powers, and here it shows up right at the start. The IRS has the authority to prescribe inventory methods so to clearly reflect income. That goes right to the 16th Amendment, which authorizes the U.S. Congress to have an income tax, and we'll talk a little more about that later. So there are basically three kinds of categories of operators out there, and they sort of fall into these three general areas, right? Under Section 471 Treasury regulations, so this is the commissioner's expression of its authority under 471A, we have different categories. The first category is manufacturer and growers. Manufacturers and growers are required to report their inventory under Section 471-11, unless they are under 471C. And under 471-11, they basically get to put all of their direct costs into cost of goods sold and their indirect cost as well. We'll get a little bit into those indirect costs, but basically a producer, manufacturer, and I would include number 3 down there, vertically integrated, which are also producers, have the best, shot under Section 280E. 280E impacts them the least. In the middle there, dispensary reseller is impacted the most as far as the majority of expenses that they can put into cost of goods sold. And generally, that is limited to the price of the product that they're purchasing for resale, the cost to get it into the door, and the code says other costs incident and necessary for the acquisition of inventory. But we'll see later that maybe we wonder what those are, and are there any, is where the law kind of is now. So much, much smaller. And if you think about that in a sort of a production line, right? A producer's cost of goods sold really includes everything up to final packaging for sale, right? So if you're growing your marijuana, all of those costs are part of your cost of goods sold. And once it's in your wholesale packaging, let's call that 1 pound bags, now your COGS start and your stop and your 280E starts, right? Differently, a dispensary 280E is everything outside of the business, all the costs of getting the marijuana into the business. And once it's in the business, now cost of goods stop and 280E starts. Indirect COGS for a producer, I said, is one of the areas that is not available to a reseller. What are they? There's sort of 3 categories. There's costs that are required to be included in cost of goods sold. Those are the direct costs, generally, of producing the inventory, spare expenses, maintenance, utilities, rent, indirect labor, all of that stuff. I'm sorry, those aren't the direct costs. Indirect costs that go into the product pretty directly. There are costs that, if they're capitalized on your financials, which, by the way, is required to be GAAP under Section 471A. If they are capitalized on your financials, then you can include them in your cost of goods sold for tax purposes, and you can see those there. And then the third category, we call them the 2 little I costs. The code is really weird. It doesn't say that you can't put them into cost of goods sold. It says that you're not required to put them into cost of goods sold. And the IRS has interpreted that to mean you can't put them in cost of goods sold. And this is another instance where the code, it's not speaking to the cannabis industry. And there are some costs in there that don't make sense. For example, interest is one of the costs that's listed there. If you have interest on a production asset, you can put it into cost of goods sold. But there it is, listed, interest, just generally as a cost that you can include in a cost of goods sold. Another situation where in audits, the IRS has been giving that to me since 2013. I'll bet if somebody tried that case, they'd lose. So watch out. Those are the indirect expenses. That's where the real heat is on these 280E audits. And this is where it applies to a vertically integrated producer, so one that both grows and sells, or just a producer, or just a manufacturer. So like a company that produces marijuana oil, brownies, cookies, etc. Okay, next slide. So I told you we talk about CHAMP, sort of the very first case that really got into 280E. There's a couple things I want to say about CHAMP. Number one, set up the idea that a single company could be 2 separate businesses. And that holding is very specific to the kind of business that CHAMP was, or perhaps still is. CHAMP was an AIDS clinic. It was an AIDS clinic that had real doctors, real nurses, all those folks at it, and as part of their services, they started providing medical marijuana to their AIDS patients. And the holding in that case is really tied to those kind of facts, right? But the holding was essentially that a dual-purpose business not prohibited from deducting expenses attributable to the business that is not illegally trafficking, right? So the AIDS clinic portion of CHAMP was not subject to 280E, and 280E only applied to the actual trafficking activity. And the court then apportioned those expenses because they were shared expenses of a single entity in a single facility. It then apportioned those expenses between the non-trafficking and the trafficking activity, okay? So we kind of got that basic roadmap that's really kind of led all the cases that follows, where we are apportioning expenses between different buckets. For example, if you have an individual that is working in both the grow and the retail, some percentage of that individual is cost of goods sold and some percentage is 280E, and you would have to apportion the cost associated with that individual. This dual purpose business that was set out in CHAMP has been a real folly for a lot of folks out there. What happened is that, again, sort of some advice that was maybe kind of bad advice, maybe it was taken wrong, maybe it wasn't fully followed through on, but anyway, a lot of people said, oh, great, I sell, they call it glass in the cannabis industry. Those are the bongs and the pipes and all that stuff. I sell glass and T-shirts, that's a separate business. Well, okay, great. There's a test to be a separate business, and it requires that you have a profit intent. You have to have a reasonable intent to make a profit. And so great, you wanted to have your glass and T-shirts be a separate business. Theoretically, that's not problematic, but if you take so many of your costs and put it on that separate business that it will never make a profit, you don't have a separate business. You just failed the test. And that's what a lot of people try to do, and that just doesn't work. If you create a separate glass and T-shirt business, and let me say this, I think the addition of CBD opens up that door a little bit. Make sure you do it in a way where you actually have an intent that you can improve that you are making a profit here. So if you assign so many expenses to that business that it can never make a profit, you just lost. And you didn't reduce 280E, you just created another 280E entity, and you may have doubled 280E. So watch out.
Can I ask one question there? Just because this stands out in my mind as a very legal, nuanced area when we talk about the content, the percentage of THC that a product has and its legality, if we're talking about hemp and CBD. If you're dealing with a vendor who's providing you the CBD, you're not manufacturing it yourself, and you rely on their assertions that this is in fact CBD and is under the required amount of THC, but that turns out to be false, have you now put yourself in a 280E trap by relying on a vendor's assertion?
Yeah, you very well may have. It is as you said, it's according to the percentage of THC in the product. And you can go from being exempt from 280E to being subject to 280E based on that level of THC. We haven't seen that case yet, but I think it's a real possibility that's out there. In fact, any business that's selling something in violation of the Controlled Substances Act could potentially be subject to Section 280E. That could include big pharma in the opioid industry. So heads up on that, folks. Good question. Thank you. Okay, so some important factors. I'm just going to list them there. There's a whole list of factors that will determine whether a business is a separate business or not. They're set forth in the CHAMP decision and in later decisions as well. One of the important things to understand is that CHAMP is still good. This separate business concept, still good law. Recently in Patients Mutual, they cited it as good law and then found that Patients Mutual hadn't satisfied the test, but it still is potentially good law. And it's still out there. Some really important things, though, of course, as I mentioned, profit intent. If the facts don't show it, you don't get it. Formalities are important. You got to follow, you got to file your articles, you got to do all that kind of stuff. Proper capitalization is huge. If you undercapitalize something, put it in a position where it's going to generate a bunch of losses, that's not properly forming a business. You lose the protection of the corporate form in that situation, separate books and records and all that kind of stuff, right? watch out for the glass and t-shirt idea. Okay, this glass and t-shirt idea came up in Olive v. Commissioner. It's a bit of a funny read because you can tell the court doesn't really like the marijuana culture, and they make some comments that are kind of humorous from that perspective, I suppose. You know, basically they tried to say, hey, look, our free yoga and pizza and lessons on how to vape that's a separate business, right? Wrong. Again, we get one little opening in Champ, and we have this case and a bunch of other cases that follows with just the worst facts ever to fit into that case. Watch out for that stuff, guys. Okay, what other kinds of businesses? There's so far in the case law, we've got one type of business, dispensary. That's it. There are a lot of other types of businesses out there in the cannabis space. And it's important not only to understand that the case law right now is not speaking to those businesses, but more importantly, what probably fits in here, right? So delivery, big one. I have not gone to an event and stand up in front of a crowd and not had 10 people ask me about delivery. Do you really think Section 280 applies to delivery? I don't know. It sounds like trafficking to me, doesn't it? I think there are some important considerations. Who's the seller, right? Remember, the definition of trafficking has to do with selling. So who's the seller here? I think that's an important aspect. Although, as we'll see in alternative healthcare, it may not be the single most important aspect. How is the delivery fee paid, right? That's an interesting question, because so you have a delivery service, it's partnered with a dispensary, right? Let's say the dispensary is selling everything, collecting all the money, including the delivery fee. Delivery is subject to 280E for the dispensary, right? It's post-acquisition of the inventory. So if it's collecting a fee from a customer, is that income to the dispensary? And then now, if it pays that fee to the delivery company, does it get to deduct that? It doesn't, right? So there's a real issue in the background here about how that relationship is handled. So heads up on that. Watch out for that. And then, you know, those facts go to determine, are we a reseller? Are we a service, right? If we're just a service, like your HVAC service or any others, your legal services, your CPA services, and you're not really selling marijuana, are you subject to 280E? We don't know yet, but if I was a delivery, that's where I would be trying to get myself to. Testing labs. I've written some opinions for some clients on testing labs. I don't think testing labs are subject to 280E. They're not buying and selling marijuana. It could be interesting what they're doing with it, but generally, I don't think they'll be subject to 280E. The glass and t-shirts company, watch out. Management companies are an area where there was a lot of sort of bad advice out there about, hey, put those costs in a management company and they won't be subject to 280E. Ha ha. Watch out. Management companies are a dirty word in the IRS, and it can be really problematic to think that you can set up a management company structure, and then which is really requires some very, very technical compliance around a case called alternative healthcare, and then go away and have your clients, you know, meet that technical requirements. It's tricky, so watch out. Landlords and holding companies. Look, we're going to hear in alternative healthcare that if you have control of a cannabis company, you're subject to 280E. So if you're a turnkey grow that hires a grower and you think that grower is the only one subject to 280E, give me a call. We need to talk. Intellectual property companies are another really important area in the cannabis space. Look at actually, it's not alternative healthcare, it's Patients Mutual. Look at Patients Mutual. They tried to claim that their IP was a separate business, and the court ruled that they didn't get there because they didn't treat it as a separate business. And there's some really good facts that are listed in the case on what it takes to form an IP company as a separate business. I think an IP company is a very important company for any cannabis company right now. You need to set it up, it needs to be a separate company. Okay. Choosing the right entity structure. So look, there's a lot that goes into this. Licensing requirements could bear on the designation, residency, public company requirements, mutual benefit cooperatives are a kind of company that's a state-level nonprofit that was required in many states for the medical industry. Exit requirements, how do you want to get out of this? Do you want to sell? Do you want to stay in this business? And of course, Section 280E, how does it fit into your entity structure, right? Really, all those things are extremely important. It's a pretty decent conversation to get to the right entity. Here's the basic gist of it, though. There's a big difference between the way Section 280E impacts an owner of a C corporation and an owner of a flow-through entity. We all know flow-throughs are what? S corps, LLCs, taxed as partnerships. So the big difference, of course, is because 280E creates phantom income. So it creates taxable income, but not actual income. So in the essence of that is that if you are the recipient of that income, you pay tax on more income than you receive. So we see many, many people in the cannabis industry that have income of $2 million, but real income of $600,000. And you can get yourself into a situation where you pay more in income tax than you actually made in your business very easily in the cannabis space. It happens. So what are the difference? In a C corporation, you have company level tax. So that means that that phantom income is the responsibility of the company. Differently on a flow through, that phantom income is the individual owner's responsibility. And in that situation, the C corporation, it would be a company audit. And if you're in a flow through, that's an individual audit because it's your tax liability. They can't audit the company and make an adjustment without auditing you, owner. And when they audit you, owner, they have a requirement under the Internal Revenue Code that requires them to look for what are called LUQs, large, unusual, and questionable items. There is not an investor out there in the cannabis industry that doesn't have a few LUQs. And that is a really, 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 really big reason why these folks don't want to be in a flow through. Company collections versus individual collections. Right now, if you have a giant tax liability because of 280E, and that's the company's tax liability, well, that company is an income-producing taxpayer. It employs individuals. It pays money out, and taxes are paid on those funds. So the IRS will say, well, what's its ability to pay? And if it doesn't have the ability to pay its liability, guess what? It doesn't have to do it, and it'll get away with not paying its full liability. But if you're in a flow-through, now it's your personal liability. And now it's attached to your home and your retirement assets and your interest in your other businesses. And you might be a lot different when you try to get out of that 280E tax liability. It could go away in one case and not in the other. That could be completely reversed. If you have nothing, well, maybe you want to do it that way, right? Because the IRS can't take anything from you. You're going to live a life where you're going to have a lien filed on you for a long time and have really bad credit. But look, the marijuana's good. What else? Double tax on dividends is, of course, the reasons why people don't want C corps. And it's a very legitimate reason. If you're paying out dividends, you'll be paying tax in the 40-some% range on those dividends because the company can't deduct them. Whereas an individual would be paying tax in that 30% range. So there could be a higher tax that was paid if you want the protections of the C corp. Exit plan is really important here as well. In the cannabis industry, in any industry, buyers, when they're purchasing businesses, oftentimes drive the terms of the sale, whether it's an entity sale or an equity sale. And if you are in a C corp and you're selling your assets, the sale of those assets is a double taxable event because it's taxable to the C corp and then taxable as a dividend as it's paid out. So exit strategy becomes very important as well. Okay. Let's get into the case law here. So we got recent case law. Melissa, I'm not sure how recent is, to tell you the truth. 2018, I guess I'm thinking that's old in the cannabis industry, right? That's like ancient time. But I think in the case law world, that's very recent. You'll see in these cases here that they're not in exact date order. I've got them kind of divided up into two categories here. So the first three cases, Alternative Healthcare, Richmond's Patients Group, and San Jose Wellness, those are cases that look, those were cases where they thought they were going to prove that 280E was unconstitutional, and that was their primary focus. But there's some real tax issues that come up in those cases that reflect on 280E outside of whether it's constitutional or not that are important. And so that's why I've got those three cases grouped in the first three. And then the constitutional argument first kind of really showed up on the radar in a big way in Northern California small business, where the dissent set forth the dissenting opinion and really laid out the roadmap for the 16th Amendment argument. And then we have Patients Mutual, which tried to follow that roadmap, but fell off it along the way, shall we say. So let's get into it. Okay, so Alternative Healthcare Advocates v. Commissioner. So this is a dispensary. These are all California cases, which is important thing for me to talk about first. Look, these cases, including even most recently Patients Mutual, none of these cases are cases that were years of a fully legalized industry. They are all coming from the sort of cottage industry phase of the California market. There's a lot of money in that cottage industry, but it still didn't have the regulations. There were no state level regulations. There was no seed to sale tracking requirements. There was none of that, right? And so, you know, those of us that have been thinking about cost of goods sold, we'd like to think about, look, if by law I am required to incur certain expenses in order to acquire and sell inventory, security, for example, shouldn't those be included in cost of goods sold? We don't have a case on that yet, because we don't have a case that is in a fully regulated industry where those kind of requirements exist. And so those are some important things to understand about the cases that we're about to go through. They're just not representative of the full industry that we see in many states today. Okay. First is just a big dagger, right? Look, this is a reseller, right? And the court said, look, reseller, you don't get anything as cost of goods sold other than what we're calling invoice price. You don't get inspection, testing, trimming, drying, packaging, labeling, inventory, maintenance, any of that. Those are all the activities of a reseller and not a producer. Horrible, horrible case law. Again, I think they were focusing on the 16th Amendment fall, and we got this bad ruling on this piece because the code specifically says that the law, that cost of goods sold include other costs incident and necessary for the acquisition of inventory. And so you've got to think some of this stuff should be included in those other costs. I will tell you that behind the scenes, we get these other costs all day long in our audits. But here it is showing up, horrible case law. Now that this case law has come out in a number of different cases, it's getting harder and harder to get them in our audits, though. What else did we find? The real second dagger of this case is that they found that both a dispensary and a management company were both subject to Section 280E, even though the management company was unlicensed and the sales occurred in the dispensary. So how did that work? So in California, like other states, I think Arizona, New Mexico, and others, you got started out in a mutual benefit cooperative, a state-level nonprofit. If you had one of those mutual benefit cooperatives, which, by the way, those are owned by nobody, a lot of them, you wondered something. How do I get my money out of that thing? And the answer was form a management company. So you form a management company. The management company operates the totality of your business. The mutual benefit cooperative is just there for the license. The income, all the sales come in are reported as they have to be because it's the only one that has a license to sell on the MBC's return. And then that amount is paid over in full to management company as a management fee. And then management company pays all the employees, buys the marijuana, does all that stuff, makes all the deductions, and then the profit flows through to the owners. Well, what happened? Well, they took the position, again, careful what you do when you're taking chances in your tax world. They took the position that nothing they did was subject to 280E because their business did not consist of trafficking in a controlled substance. And so the court, I mean, we'll get into the factors, but the court basically said, well, look, You don't think it applies to you? Guess what? Here's how we're going to apply it. And we're going to apply it to both places. And guess what? That management company is a flow through. And so it's going to end up applying to all of you personally as well. So it really kind of ended up, 280E ended up being applied at the dispensary level, management company level, and individual levels. It almost tripled it from what would have been, probably they could have settled this case if they wouldn't have gone to court. They could have settled this case. The IRS would have agreed to put the costs that they agreed were cost of goods sold into cost of goods sold, and that would have been the result. Here, they ended up with double application. That might not matter. That MDC may be dead, and maybe that's why the tax court did that. They might have known that as well. But so what do we do here? Look, there are a lot of cannabis companies out there that have multiple entities. If you have multiple entities, you need to be concerned about this case. It does not stand for the principle that absolutely if you have multiple entities, 280E applies to all of it. It doesn't go that far. So how far does it go and what are the factors? The factors are, number one, common ownership between the two entities. That allows the IRS to reconsider the relationship. If it's a non-arm's length relationship between those two entities, the IRS can recast it for tax purposes. If it's arm's length, they have a harder time doing that. Abuse of Section 280E, that's probably the biggest thing here. I still know a lot of guys at the IRS. I spoke to some of them after this case came out, and I said, gosh, am I subject to 280E? And they said, Nick, you know, look, we think this case, it stands for abuse. And it is a case that is about abuse of 280E and what may happen if you abuse 280E. Another factor, the management company actually employed the employees that were selling the marijuana. They were the employer for the employees that were trafficking. Bad fact. They actually controlled the day-to-day activities of the sales, of the trafficking, right? They were in control fully. They employed the bud tenders. And that last fact is just that it will allow the IRS to reallocate, right? So those factors all come to play, and those are the factors that you're going to want to be looking at when you have multiple entities. And the very, 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 very most important factor is going to be identify where you want 280E to be, where it should be, put a big circle around that, and don't let it out. That is really important. Don't let it out and treat it properly in that entity. And that really minimizes the chance that it flows to the next entity. There's more to it than that, of course, but that is a very critical piece of the whole thing. Okay, Richmond's patients group. So along comes Richmond, and in Richmond, another case of what is sort of possible behind the scenes. So Richmond files a Form 3115, which is a change of accounting method, and basically requests to put all of its costs into, or a majority of its costs into cost of goods sold. That, of course, was denied by the IRS. Which it does have the authority to grant or force a change of accounting method. And they reiterated the requirements that 280E applies, even if legal under state law. And because that change of accounting method was the critical thing they were fighting for, it doesn't look like in that case they got some of the things that should have been put into cost of goods sold in a case that would have been an agreed case with the IRS. And we got this negligence penalty ruling that basically said, look, you didn't reasonably rely on your professionals because you did this funky thing, and so you're not subject to reasonable cause relief, and so you're now subject to the negligence penalty. That is another theme that's in the background of these cases, is this negligence penalty. Early on, we saw a lot of relief on the negligence penalty. The IRS realized the law was unsettled, and that they can't really impose a negligence penalty when nobody knows what the heck to do. That sort of changed in 17, 18, after some cases, Olive and other cases came out. They said, look, you guys should know better. Negligence penalty applies. Then we'll see Patients Mutual came out and said, wait a minute, the law's unsettled. Negligence penalty doesn't apply. And now here comes this case and says negligence penalty applies. You got to work through them. And you got to be able to, link to that stuff. You got to, ultimately, the thing that's going on here is, yes, the law is unsettled, but if you're sloppy and you can't prove that you paid for your deductions, you're not going to get that, because they're going to say you didn't have proper books and records, and for that reason, you're negligent. And so it really requires a good CPA on your team to get everything substantiated, show you're doing it right, and then a Reliance defense may work. Okay, San Jose Wellness now. Where alternative healthcare went so far in one direction, and basically, the holding in that case could apply just, to light manufacturers, where it seemed to just really broaden 280E. Along comes San Jose Wellness, and it seems to narrow 280E a little bit. So again, another reseller. These are all reseller cases, all out of California. Wish they'd stop litigating these things, but whatever. Again, they argued that this idea that, and I guess I didn't really explain this argument. This argument has been in the cannabis industry for a long time, as long as I've been around. And the idea is essentially because 280E says that 280E applies to a business that consists of trafficking. The argument is that if we do anything else other than traffic, our business doesn't consist of trafficking. Interesting argument. It was brought up in a number of different cases. It was fully brought up in the Patients Mutual case in the tax court level. Here it was brought up as it was in other cases, and it was denied pretty much out of hand. We'll get into, I guess I don't talk about this argument much because we get into the appeal on Patients Mutual, but it's interesting. In denying the argument, they cite all these examples of the usage of the term consists of. And all of those examples are kind of fall into two categories. Either that's the only thing that follows, so it consists of something and that's it, or it consists of something and that's the majority of what it consists of. So the tax court sees all of those different kinds of usages, and it doesn't find that it has to be a majority or the exclusive thing that's done. It finds that any instance of trafficking, and it's all trafficking. That's what it finds, right? So another instance where we're trying to get this little, and bam, it ends up this giant problem, right? And expands it to who knows where. So San Jose Wellness is sort of the one case that shows that there could be some limits here. So what happens here? So what happened in San Jose Wellness is that they were arguing that charitable contributions were not subject to 280E because they were not paid or incurred during the taxable year, because they were carried forward to other years. Well, there's a whole bunch of case law that says that that's not the way that the world works. And the court pretty much dismissed that argument out of hand. But then the court on its own said, but in carrying on that term, in carrying on a trade or business that consists of trafficking in a controlled substance, in carrying on is narrow in the sense that it only applies to expenses incurred while conducting a trade or business and not to expenses incurred before a business commences or after its conclusion. So what does that mean? Before I get to that paid or incurred now is really important. Accounting method is going to dictate when a payment is paid or incurred, right? So heads up on that. So what does this mean? Well, the court goes on to identify that it wouldn't apply to startup expenses before the business begins, right? So once assets are put into service and the business, quote, begins, that's when 280E starts as well. So what are the possibilities there of stuff that isn't subject to 280E? Well, of course, startup expenses. And startup expenses has kind of a strange history to it. So it was an area that early on we thought, well, what the heck is that? That's before we even got our license in many instances, right? And surely that can't be subject to 280E. And so in the early audits that we had, the IRS would give us startup expenses for production activities, right? So you have startup expenses to start a grow, or we call them MIPS. Marijuana-infused product license here in Colorado, but manufacturing, some of those costs, if those are startup costs, we'll give you those. You can go ahead and capitalize them and take 1/15 as cost of goods sold each year. But if it's a dispensary, you don't get it. And so that was the way the audits were for probably 5-6 years. And now this case comes out. Well, this case is a dispensary, and it doesn't say only producers. It says that 280E doesn't apply. So what does that mean? Does that mean that we can now take our startup expenses for building and starting a dispensary? It's a little bit trickier because The process then is to capitalize and put them into cost of goods sold, but dispensaries don't get cost of goods sold for things other than inventory price or invoice price. So how does that work, right? Another situation where the law and the code is just they're not coming together quite right. I would suggest that put it into cost of goods sold. Let's fight that fight. The other part of where in carrying on might not apply is after the business commences, and that's a little less clear on what that might be. But I think about wind-up costs, and there could be some lending costs that could maybe show up at the end. I'm not sure, but I just throw that out. Another area where I think where this case is useful is with the landlords, holding companies, et cetera. This shows some limitation, right? And so if I am a holding company, I want to point to this case and say, look, I'm not in carrying on a trade or business. That's that other company. I'm not subject to 280E. Again, this is one end of the spectrum where alternative healthcare is at the other end. Okay, so along comes Northern California Small Business Assistance. And in this case, again, another sort of argument that didn't work. But in the dissent, the court came out with a statement that has really shaped the landscape for quite a while to follow. There's some of the more law that you've seen in the other cases. They re-echoed a lot of that law and held for the first time, I think actually the second time, that the Eighth Amendment didn't apply to Section 280E. But Judge Gustafson came out with a very thought out dissent, basically holding that income is gain, and because Section 280E would cause a tax on more than gain, it is unconstitutional under the Eighth Amendment as an unreasonable fine or penalty. You had to use the 16th Amendment to get to the Eighth Amendment. I don't think we have to do that. I think we can stop at 16, but that was how this case was teed up. And his dissent was specifically that he would hold that the 16th Amendment does not give Congress the unrestricted power to impose as a tax on incomes the liability arising from the disallowance of Section 280E. And it goes on. You've got your slides. You can look at it. This case law then, and there was a lot of good citations to a lot of good constitutional cases. Now this case law shows up in our next case, Patients Mutual. So when Richmond came out, there were a number of cases already in the system, and all the lawyers on those cases saw Richmond and said, "That's what I want to argue. That's the way to get it. I'm going to be world famous." And so Patients Mutual comes out, and in the appeal, the Richmond dissent is really the argument of the taxpayer in the Patients Mutual appeal. Unfortunately, however, it was not the argument of the taxpayer in the tax court. And so as we'll see, because it wasn't properly teed up in the lower court, the Ninth Circuit didn't rule on it. And so we had all this great law. We were all so excited, and then we got a big fizzle at the end. My daughter loves those whoopee cushions. That's what we got at the end of Patients Mutual, a big whoopee cushion. There's your case sites right there. There is a lower tax court decision. There was actually two decisions, and then we have the Ninth Circuit appellate decision. Okay, so Patients Mutual. This is the tax court decision. That Harborside's sale of marijuana did consist of trafficking, and Harborside did not get its testing, curing, trimming, storage, or packaging costs because it was not a producer, and that penalties do not apply because the law was not developed. That penalty part was nice. That helped me with a lot of my clients for a short window until the very next case, tried by the very same people, held that penalties did apply. In these penalty arguments, note that there's a TIGTA report out there that is extremely important. That TIGTA report that came out last year, and I'll reference it later, says the law was undeveloped. It specifically says that. And so that is an important tool in getting penalty relief. Okay, so let's now look at the appeal. So the appeal now is Harborside's challenge that 280E is unconstitutional under the 16th Amendment. Basically, Harborside says that the 16th Amendment only allows taxes on income. Income equals gain. The tax court's holdings are wrong. Harborside's right, and the commissioner can't force a change, and Section 263 Cap A doesn't matter. So let's look at this 16th Amendment. It was passed in 1909. It was ratified. It's fully law. When I was in the IRS, there was a big 16th Amendment denier community out there. It's the law of the land, guys. It basically says that Congress shall have the power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states and without regard to any census or enumeration. It is specifically a tax on income. Income is a specifically constitutionally charged term. Okay, here it is right in our 16th Amendment, right? And that term, income, shapes our whole income tax system. It is the basis, the foundation upon which our system exists. Okay, it is the birth of the income tax system in the United States. Income means gain. That's the basic argument here. It comes from a number of different cases. I've got them all in these slides because it's really important to go through these. In Doyle, the court held that it was an actual idea of gain or increase, that it was real gain. As was said in a previous case, income may be defined as the gain derived from capital, from labor, or from both combined, right? It is actual real money that you receive, not phantom income. Income is not theoretical, right? In Eisner v. Macomber, when I was like a brand new trial attorney for the IRS, these cases were cited in every brief we filed. Every single brief we filed cited all of these cases for the foundational principles of our tax system. They're not just, way out of left field cases. These are the cases on which our system are built. And this case, Eisner v. Macomber, basically held that Congress cannot, by legislation, alter the Constitution, and that income is according to truth and substance. It isn't a sort of concept. It's not a theoretical term. It's a truth and substance term. We all know what income is. It doesn't require 500,000 pages of the code for us to know what income is. It is gain. It is what we receive, okay? And these cases stand for it again and again. The problem is that there's this other statement about how deductions are subject to legislative grace. And so this concept of legislative grace comes in, and it says, look, the legislature has the authority to determine what can and cannot be deducted, right? That comes from another seminal case here, New Colonial Ice v. Helvering, which held that whether and to what extent deductions shall be allowed depends upon legislative grace. I would put it to you that there are different buckets where expenses could be put. You got your deductions, you have your cost of goods sold, and what else do you have? Capitalization, basis. There are other places besides a deduction where a cost could be located. And here, if it's disallowed as a deduction, we know if it's allowed as a cost of goods sold, you get it, right? This case, Davis, is cited a lot, and it really breaks down this nice little principle that I believe is really critical in understanding the way our tax system works. Essentially, what it says is, look, there's two kinds of deductions. There are those kinds of deductions which are not necessary to determine income, and that's things like offsets between companies, right? Taking an NOL against a gain from another company. Us allowing you 50% of meals and entertainment, that's not an ordinary and necessary business expense. We're going to give that to you because we think some of it maybe is ordinary and necessary, but not the other part. That's your personal expense. Those kind of deductions are subject to legislative grace. The legislature, it doesn't have to give those to you for income to be properly determined. But those other deductions, 162 ordinary and necessary business expenses, those deductions are different, and legislative grace can maybe deny the timing of those deductions, but it cannot take them away forever. So that's Davis v. Commissioner. Very important to understand those different kinds of deductions that are out there and why some of them are. If you think about what it means to be an ordinary and necessary business expense, it is ordinary and necessary for the production of income, right? Well, then what is it? It must be taken account then in the computation of income if it's ordinary and necessary for the production of income, right? That's what our code says. The second part must be taken into account. That's what we're trying to prove. What is legislative grace? Now, I was talking about these two different kinds of deductions, right? Well, the first kind of deductions are inherently necessary. Those are the ordinary and necessary deductions. As a matter of computation to arrive at income, the second may be allowed or not in the sound discretion of Congress. Such deductions, as distinguished from the first kind, are allowed by Congress wholly as a matter of grace. So this I think, is really important for us to understand in the context of our 16th Amendment argument, that this concept of legislative grace, you can't use your legislative grace to rule against the Constitution. So there are limitations on how far this legislative grace can go. So essentially, taxpayers' conclusion is that because Section 280 disallows all deductions, it causes a tax on more than income, and it's unconstitutional under the 16th Amendment. Then we go into the government's brief. I'm going to go through this kind of quick because, frankly, I think it's crap. Basically, the government's argument is, income's not really income, and the 16th Amendment, that was just a door, and that door, once that door was opened, all of that law about the 16th Amendment doesn't really apply, because now we have Article 1, which also allows us to tax. I don't think so. I'll just say this: income is income. And the thought that it is this crazy technical, you got to look through all 20,000 pages of the code to get to what income is, that is just not where this is going to go. Income equals gain. That I don't see the court saying that it's different for purposes of the income tax once the 16th Amendment is passed. And it just I'm not buying it. But that's what the IRS is saying. Again, I think that's why they know that they're someday will be able to prove this. Right now, they're winning. Someday we'll get there. Basically, they say, look, income's what we say it is. You got to look to 471A. That'll tell you what income is.
Doesn't it seem, Nick, counterintuitive in a capitalist nation like the United States, where we encourage business and really try and do everything to cater to business, that this is what we're arguing about? It almost seems selfish, and when you put it this way, for the government.
It is really selfish. It is. It goes to what you just said, this idea about encouraging business. It is my belief that the deductions for ordinary necessary business costs are to encourage people to start businesses. But if you don't have that, those deductions go to basis in the business itself. We have these different buckets where we put these costs, and those costs are costs to build your business. They're not the cost to build your product. We took those out as cost of goods sold. They're the cost to build your business. And you wouldn't get to take those costs until you sold that piece of property, which is your business, but for Section 162, right? So when you sell that business, now you get to take those costs that were disallowed under 280E, because it's really just timing. That's what the IRS has control over, is timing. They don't have control over what is a necessary reduction for purposes of the 16th Amendment. That's the last slide. I just hit it real fast because I know we're getting out of time, so I just want to kind of speed up a little bit. Waiver, that was what happened in the end. Look, you didn't bring it in the lower court. You don't get it now. Have a nice day, taxpayer. You lose. This is more of the government's argument, the 16th Amendment argument. I'm not going to dwell on it. I don't like it. COGS for a reseller, we got the same decision again, that it's invoice price, another bad decision, really, really hurting resellers, right? In the reply brief, some good stuff that the government brought up, and some good case law that's worth looking at. More of the same, though. More good. This case here has a really nice quote in it that I would be using if I was fighting those cases. Look, bad precedent is what we got here, and we got to get past it. It just keeps coming up again and again and again. It's a real problem plaguing the cannabis industry. We just saw 3 days ago a case come out that said it wasn't going to re-examine the 16th Amendment because it was going to be bound by a prior opinion. That prior opinion, they just threw that against the wall and hoped they would get something, and they got a horrible decision out of it, and now we're bound by it. It's tough. Legislative grace cannot overrule the 16th Amendment. The commissioner's authority is limited by the 16th Amendment. And then the appellate decision comes out, and once I say again, it was a big whoopee cushion. Back to square one as a result there. So I just kind of wanted to get to Section 471C real quickly. 471C became law recently. We now have final regulations on Section 471C, and they basically say that for the cannabis industry, nothing has changed. TIGTA, remember I mentioned TIGTA earlier. TIGTA came out with a report last year about the cannabis industry audits being conducted by the IRS. And in the report, they said, well, wait a minute. After talking about how great 280E is for the IRS, they go, well, what about this 471C? Gosh, looks to us like you could use this to completely eliminate Section 280E. And this is their table right out of the TIGTA report, where they show the different case scenarios, with Section 471C showing no 280E applying. Really got a lot of people's attention, right? And it really started us talking about 280E. Here is the Department of Treasury saying, we think it might work. So what is it? 471C is a remarkable code section. 471C basically says that 471A shall not apply. 471A is all the law that we have so far. All the cases that we have are all decided under 471A. All of our regulations on inventory methods are all under 471A. And the commissioner's authority to prescribe methods for inventory is specifically through Section 471A. So it's remarkable when it says that 471A doesn't apply. It pretty much wipes the slate clean as far as what is and is not a permissible inventory method, because all of the inventory methods fall under 471A. It goes on to then say that the taxpayer's method of accounting shall not fail to clearly reflect income if, and there's two methods, I'm going to skip that first one, if the method conforms to the books and records of the taxpayer, prepared according to the taxpayer's method of accounting. Pretty simple, right? All of that law doesn't apply, and all you got to do is report it for tax purposes according to the way you reported it to your books and records, and guess what? It shall not fail to clearly reflect income. Now that's the statute, that's the law, that's the voice of the legislature, right? That is legislative grace. Okay, very, very, very powerful code section. And furthermore, what does it come with? An automatic accounting method change. So commissioner has no authority, 471A doesn't apply. All you have to do is report it according to your books and records, and the commissioner can't say no. That's what the law says, right? Remarkable. So what does it mean that 471A doesn't apply? Well, as I said, the regulations, the 471 regulations don't apply. The secretary's authority doesn't apply. None of that applies. Well, what are we left with? Well, you know, it's interesting. We now have final regs. We got that. Shall not fail to clearly reflect income. Another remarkable thing, right? Goes right to the 16th Amendment requirement, right? That term, income, is huge. Constitutionally charged term. Here we're meeting the 16th Amendment's constitutional test. What else is there to ask? Change of accounting method. Automatic, filed with a timely return. Form 3115. It's a little technical. You want to make sure if you're going to do something here that you do it right. Somebody knows what they're doing. You have to explain your method. It's a fairly artful statement that you need to be really conscious about the way you're explaining it. So what might be available under Section 471C? So first I want to say I don't know, and the IRS thinks nothing's available. I don't agree with that. Something changed. When you removed 471A, something changed. And that's because, look, there are technical limitations that have been applied to the cannabis industry that if I was a 7-Eleven, I would be required to put into cost of goods sold. But because I'm a cannabis company, I'm told I can't. When you remove those technical rules, you at least get to those kind of costs because nothing technically is stopping you from taking them now. And they are of the nature of cost of goods sold. So something changed here. And I would suggest that that's what I'm calling the floor. I would suggest that that change could be important for a reseller, and it could bring in other costs that are being denied to it. for packaging and those kind of things that other companies have to include in cost of goods sold under 263 Cap A. So there's something maybe there at that floor level. Certainly, I'll say this also. I have looked at thousands of 280E tax returns, and they all are playing in the gray areas. And this 471C is a better defensible position in those gray areas than Section 471A. So it is an important tool for the cannabis industry. What next? So what's the next step, perhaps? Well, I go back. What's left? You remove all the rules. What's left? Well, what's left is the definition of trafficking. Remember, buying and selling, right? So the next step in this analysis may be, well, look, let's put those things into cost of goods sold that are not our direct buying and selling expenses based upon this definition of trafficking. Next one I think about is this dagger approach. I have some very specific expenses that are so big. Investor interest, for example. I just want to put those into cost of goods sold. Well, maybe we use 471C for this dagger approach where we pick this sort of important item and we put that into 471C. Remember, 471C doesn't include any rules except do it according to your books and records. It's wide open, right? So the next one, the all-in. Personally, I think that that's a dangerous place to be playing, but there's nothing in Section 471C itself that says you can't do that. It doesn't say that. All it says is report it according to your books and records, and it clearly reflects income. That is what it says. That is the law. So when clients ask me about that, I can't say, no, that's illegal. You could never do that. The law doesn't say that. I have to say, I don't know. I think that might be a one step too far. I always remember that statement. I'm not sure if it's pigs or hogs that get slaughtered, but one of them gets fat and one of them gets slaughtered, and we don't want to be the one that gets slaughtered, right? I heard earlier about how important it is to do this stuff right. If you're going to do this method, the only thing tying that method are those books and records. Do it right. Hire an accountant, have them do your books and records on a day-to-day, monthly basis, not just at the end of the year. Do it right, make it contemporaneous, put it into your day-to-day general ledger. So it's part of your system, it's part of your method. You're not just going back at the end and suddenly affecting your 471C method. That doesn't sound to me like a consistent method, and consistency is really important in an accounting method. But that said, in the final regulations, they said that books and records include all of the records, including the preparer work papers. So if I had that case, I would argue that those work papers were sufficient enough. We got final regulations out of the IRS around this, and basically the IRS said, yeah, 471A still applies. A lot of us have said, wait a minute, you can't say that, IRS. The law says it doesn't. You can't come back and say it applies. That doesn't work, guys. And they came out with this specific statement that nothing in Section 471C permits the deduction or recovery of any cost that a taxpayer is otherwise precluded from deducting or recovering under any other provision in the Code of Regulations. That is a very, very specific type of language that showed up in the 263 Cap A statute as well, called the flush language. This is very similar to that flush language. It is very interesting that they had to put that flush language into the code on 280E or on 263 Cap A, but here they're inserting it into the Treasury regs. Is that sufficient? Can they say that in light of what the law says? They can't regulate in violation of the clear terms of the law, right? And so this is questionable whether they can even say that. Moreover, they don't talk about 280E. They don't talk about cannabis. They talk about timing. Basically, what they say is, right after this sentence, is they say, you can't put a cost into cost of goods sold that you haven't actually paid for yet. That's their example. Well, what does that do to us? So there's a lot of criticism out there around these regulations. A lot of people have criticized the regulations outside of 280E because they say 471A still applies in other instances as well, which just can't be the case, right? So we're in a strange situation right now with 471C. What do you do? Look, this could be a ton of money for people, right? This could be millions of dollars. But the law's unsettled here. We don't know the answer here. IRS has said, look, we don't think it works. So if you take this position now, you're coming in at a time where final regulations are out that say they don't think it works. So adequate disclosure becomes really important. If you want to do this, you need to be protected from penalties. And so really, if you want to do this, the posture that I think people should think about is, look, we think this works. IRS, we're going to tell you about it, and let's figure it out. That's the process, right? And you do that through what's called an adequate disclosure at Form 8275. What's left? We still have the 16th Amendment, guys. It's still out there. We don't have a ruling on it yet. And finally, my crazy theory is this basis argument. A number of people out there in the tax preparer and CPA community have also been echoing this argument. It's not just me. The idea is, look, you can't just erase an ordinary and necessary business expense. It has to go somewhere. And if it doesn't go into cost of goods sold and it doesn't go in deduction, it has to go into basis. And if you don't get to put it into basis, it's a violation of the 16th Amendment. And at the sale of your company, it's this big true-up moment. What is income? And that has to be taken into account. I would put to those people on the call that this is that theory. There's a lot of parts of the code that just don't plug in well to that theory. There are some parts of the code that plug in very well to that theory. Generally speaking, though, it seems to make our system work, right? It makes the idea of cost of goods sold in Section 471A, the IRS has said again and again, look, that's just a timing provision. That's just a timing provision. Well, let me ask you this. If that's just a timing provision, how can you use it to disallow an ordinary and necessary business expense? How can that be if it's just timing? Well, if it's just timing, we should get to put it somewhere else, right? It makes that work. It also makes 471C work because in the 471C context, the Congress has given the power of timing to the taxpayer and said, you decide where you want to put it. Just do it in your books and records, and then you do it on your return, and that's fine. And I think that's it. Did I go over just a little bit, a lot? I don't know. I can't tell.
Nick, that was amazing. I wish we could have you here for another 2 hours to continue talking about this stuff. I think talking about some of the fundamental theories of what income is in and of itself is a presentation we could sit here all day and listen to you speak about.
I would really encourage people to look at those cases. You know, there's some real meat there.
And reach out, please. Like, if there's anything that today should teach us all, in listening to you and in listening to some of our other panels about the complexities of this industry, is that when applicants and existing operators are looking for their advice of the advice of a CPA, you need a Nick Richards there to help you understand what the real liability is. Or where there's some wiggle room with regards to these projections. And I guess we have a ton of questions in the chat. We're not going to be able to get to them, unfortunately, but we'll send them out to you. The one thing I would want to know is, you know, as we're talking about, a big theme of the day is New Jersey homegrown small business. You know, the multi-state operators are there and they've paved the way, but we're looking for an organic New Jersey industry, and we're hopeful to have a mom and pop type environment. When clients are calling us, one of the things I always wonder is, you know, 280E is such a burden. Am I steering somebody wrong by advising them that this is a good industry to be in right now? Or is there kind of this wait and hold out, you know, pay the 280E tax now and it'll be worthwhile when it goes away? What are your thoughts on that? And I'd like to close out with that.
My thought is C Corp, C Corp, C Corp. If you're getting in this industry, if it was me, I would not go into the industry in anything but a C Corp. I mean, basically, there's just too much exposure, and a C Corp will protect you from that more than anything. And what I tell people is, look, don't, you know, I think it's called the Vice channel, you know, put those programs with those piles of money out of your mind. That's not the reality in the cannabis industry. Frankly, most businesses are struggling to make a profit. And that's the reality of of a mature cannabis industry. Sure, early movers do real well, real early, but that changes in year 2, 3, and 4, and the industry gets really competitive really fast. C Corp, C Corp, C Corp.
Excellent. Listen, this was amazing. I cannot thank you enough for your expertise. I encourage everyone to download Nick's slides and continue to use him as a resource going forward. I know him and I have a lot of very interesting conversations, and he's just really a great person to know. So thank you, Nick. We cannot be more appreciative.
And I'd be happy to take an email or talk to anybody. My information is up there. We're a community.